And on today's show, why fiduciaries have a heightened responsibility to examine life insurance policies. Part 3 of this week's series on life insurance policy reviews with policy due diligence expert and certified financial planner, Sam Roque. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Innsmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Sam.
Thanks, Steve.
Day 3, how are you hanging in there?
Great.
We have Sam on because his due diligence expertise is so huge. And if you've missed Monday and Tuesday show, I highly exhort you to go back out and watch the show in succession. There's some kind of chronology in our shows, kind of a sequence, and I think it'll really help your learning experience. And today we're talking about the fiduciary responsibility, and I want to bring up the basics of tax attorneys, probate attorneys, estate attorneys. How about CPAs that review their clients' money positions? Remember, they all think it's all tax. Sometimes it's money, and especially trust officers who are actually holding second to die trusts, single contracts in line. How much of your due diligence and due care process, Sam, really deals directly with these fiduciaries that I've just named?
That, Steve, is our primary driver. Our primary driver is to make our advisors very marketable, very professional in front of the professional advisors, the critical fiduciaries, like you said, because ultimately they're the gatekeepers for a lot of people. They're the people that are making the recommendations, and I think the reality is a lot of them have their clients have policies. That professional advisor doesn't know what's going on with the product. They're a little nervous about it. They probably wonder, okay, is it in good shape? Is this a future liability for me? But at the same time, they're not really sure who to go and talk to about it. They tend to view life insurance advisors, life insurance agents in a little bit of a negative light, and so they're just not sure who to trust.
But it sounds also like you're using this, supporting your advisors by using this as a marketing tool to get in front of these fiduciaries. And you're doing all the heavy lifting.
Right.
It sounds like that means that you have to actually, from an advisor's point of view, we have to collect the right information.
Oh, absolutely.
This is where the real game is played.
Absolutely.
You're doing the lifting, but if I don't give you the right data,
right.
And you have data collections for all this.
Right, absolutely. Yeah, we have questionnaires and ways to collect the data. And like you said, if you don't have the right data, you don't get the right output, and you don't get a good feeling for what's going on.
Is there a difference in your practice? You've been doing this for so long. Is there a difference in your practice between speaking to advisors on policy reviews and speaking to fiduciaries on policy reviews?
Absolutely, there is, because a fiduciary has a very different kind of lingo, different kind of language, and they want this to be as objective as possible. And that's why we try to be as objective as possible in our reviews. Like I said in our prior segment, we don't lead with replacement. We lead with, here's what you have, here's how it's performing, and here is what the market looks like. But ultimately, we want to use it as a way for a fiduciary, a trustee, or a CPA or attorney just to say, look, I've done my due diligence, and I know it, and we've talked about what you have. Here are some recommendations we might make, and where it fits, where it's appropriate, we might recommend a new policy or a new product. And like we've talked about, the new products are really good. They're really strong. They're better than the old products, and so 65% of the time we're able to put them in something that is a little better option.
Now, 35% of the time, then, we really can't move the client.
Right, 30%.
And we tell them that.
Yeah, and that 35%, in my opinion, is one of our most valuable selling points to an advisor, because it gives them a lot of credibility in that center of influence's mind. It says, look, I'm not out here to make a sale. I'm not out here to make a commission. This says, hey, I'm out here to do a really good job and to help your clients.
We don't really have standards on this, and I noticed that you have listed in one of your slides the Uniform Prudent Investors Act. In the security side, we're all over this. On the insurance side, it doesn't seem like we have standardization on any of this.
Right. It definitely is a bit of a black box and a bit of an unknown, and everybody does it a little bit differently, and there are different ways to do it. Ultimately, we feel like we just want to help people understand what they have and understand what's on the market to help, frankly, prevent them from future liability. Because if somebody, a beneficiary 20, 30 years down the road says, hey, there was this better product back in 2014, 2015, why didn't you take a look at this? We want to at least make them aware and make the clients aware, frankly.
No advisor can do the kind of due diligence that the team like yours does. I mean, we can't track all 80 brokerage contracts. We don't know the underwriting. We don't know every product.
Right.
Although we do a pretty good, I think on this show, we do a pretty good process of keeping everybody up to snuff on what's going on. But still, it's difficult. But you guys do this every day.
Right. We've got 7 people who are doing this all day, every day. This is our only function. And so we're really digging down, and we've gotten really, really good at analyzing existing policies, understanding what's going on, communicating what's going on to the advisor and to the client, and ultimately coming up with some recommendations.
And the fiduciaries love the way you guys do your process.
Absolutely.
We come back from the break, and we're going to talk more about the fiduciary market and how policy reviews can put you in front of the deal makers and gatekeepers right after the commercial. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, we're with Sam Roque, expert in due care and due diligence on policy reviews. We're talking about the fiduciary market, and boy, these are people I want to get in front of as an advisor. So walk me through basically some of the stats here, because to me, these are 3 big ones we need to know.
Right. So the first one is 74% of trust-owned life insurance can be structured to provide greater value. That's within the current policy and with a different policy. So 75% of the time we're able to make a recommendation that provides value to the client, value to the family, helps prevent an issue down the road. So that's huge. 74% of the time we're able to...
If you add value without changing the policy, some registered investment advisors actually charge a fee for that.
Correct, and we're doing it for free.
Wow, that's huge. That's a huge support mechanism. What about this $32
million households own insurance policies that are not appropriate for them. Wrong beneficiary designation, the trust maybe is outdated. There's an issue where they own it in their estate and it's going to create an estate tax problem. Somebody didn't do the proper planning, 10, 15, 20 years ago. So that's a huge area where we're able to provide value. And again, it's not a replacement. Sometimes it is, and sometimes it's simply moving it to the right structure, making the right adjustments to do the right thing and do the best thing for the family.
It's something when you think you should own something and you should know about it. But you say 64% of people who own policy have no clue what they have.
Absolutely. Most everybody who buys an insurance policy puts it in a drawer. They put it away. They trust their attorney or their tax advisor or their trust officer to manage it correctly. And they in their mind they say, I'm going to pay this premium and it's going to be there. We use this statement a lot where we say, do you know that if you pay the premium you've been paying all these years, your policy can still lapse? And a lot of people are just blown away by that because they figured it was guaranteed or something like it, or their advisor at the time gave them some level of comfort that what they were seeing on the piece of paper was going to happen. And frankly, it just hasn't. And
sometimes that could turn into a liability issue for the advisor.
Absolutely.
Talk about the standards and some of the factors that we look at.
The standards, we're going to do what we call starting with why. We're going to understand why they bought the coverage, why they need the coverage going forward, what some of their goals and objectives with the review are. Maybe they want to stop paying their premium, or maybe they say, look, this premium is fine. I could even probably divert a little bit more to insurance, and I really like this insurance stuff. I want to do something really cool for my family. And there we're looking at this as a living concept, a living transaction, to where we're really going to find out what makes that family tick a little bit and kind of get the goals and objectives first to make sure that we're doing a really good job for them.
This is beyond just doing an illustration.
Oh yeah, absolutely. It is, and for us, it's about impacting a family and making sure that it's the right solution.
Well,
for
some
them.
of these factors that you have are serious impacting. Just walk me through this real quickly.
Yeah, interest rates are one of the biggest things that we deal with each and every day. Policies are underperforming because of interest rates, because interest rates have dropped. There's no doubt about it. 20 years ago, policies were crediting a much higher interest rate than they're getting today. And so policies have suffered because of that.
You're even looking at inflation on this.
Right, inflation is an issue. Longer life expectancies is a big issue.
Big one.
People are living a lot longer than we ever thought they would, and so therefore they might outlive they might even outlive the maturity date of their policy.
That's a stunner, just that alone. I wish we had time to go into that.
Yeah.
Medical advances, of course, we're seeing this all day long.
Right.
Everything's changing.
Yep.
What about industry improvements in product and pricing? I mean, in the last 5 years, it's like a new industry to me.
Mm-hmm. Yeah, as the industry evolves, the carriers have come up with new and unique products, pricing methods, riders to add on to add value. We discussed this a little bit in a prior show. Long-term care riders are really big right now.
How about chronic illness? Is everybody touching that as well, or no? Is it still more LTC?
No, chronic illness is coming out in a big way. There's some subtle differences between chronic illness and long-term care that can be very impactful that the client really needs to understand. But ultimately, we're just looking to add value, and so chronic illness is a good way to add value as well.
Now, we're looking at your proprietary process, Sam. We got about a minute to go. Give me just a walkthrough here of the 6 basic gauntlets that I have to go through in your step process.
Yep. So really, what we're going to do is we're going to start with goals and objectives, and then we're going to analyze the current product, and we're going to say, okay, does this fit the goals and objectives? What does the health of this policy look like? And then we're going to review the market. We're going to look and say, okay, what is the market providing? What's out there in the market? How competitive is this? What is the relative value compared to what you can get out there? We're going to negotiate with the carriers, and we're going to say, look, we need a preferred here. We need a standard plus. Can you get it for me? A lot of times if we ask, or if we ask the right way with the right information, we can get that rate class.
And you're skillful at that area, by the way.
We're very skillful at that area. And then we're going to provide them a recommendation.
Now, when I walk through this, I don't want to overrun this as we're closing the show out, but this is really an issue when you're dealing with as many policies as you deal with, and as the size of the not only the carrier, maybe his retention, but the size of the actual IMO that you're running this business through. Right. This issue of negotiation can be a huge, huge silver bullet.
Right.
Unbelievable. Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. See you tomorrow.